Greenland looks like a footnote on the world map, vast, frozen, sparsely populated, and seemingly disconnected from markets, currencies, and power politics. Most people think Greenland is irrelevant. That belief is about to cost Europe billions, because almost overnight, this cold island has become the center of a hot crisis. What began as a territorial dispute is now morphing into something far more dangerous: the threat of a trade war between allies. Tariffs, retaliation, alliance strain, and market uncertainty are no longer theoretical. They are already being discussed in boardrooms, ministries, and trading floors. The stakes are startling. Investor confidence doesn't collapse over ice and snow. It collapses when rules between allies fracture. When the United States openly pressures Europe over Greenland, it's not just a diplomatic argument. It's a signal that economic weapons are back on the table, even among partners who once trusted each other. Here's the paradox. Greenland looks small on a map, almost invisible next to giants of global trade. But geopolitically, it sits at the crossroads of power, security, and future wealth. Shipping lanes, military positioning, and strategic leverage converge here. This moment feels sudden. It isn't. To understand why Greenland matters now, we have to rewind back to the unfinished history that made this confrontation inevitable. This isn't Trump being random. This is unfinished Cold War business. During the Cold War, the Arctic was never empty space. It was a silent front line. Greenland hosted U.S. radar systems, air bases, and early warning infrastructure designed to detect Soviet missiles before they reached American cities. Power wasn't visible, but it was constant. Then the Cold War ended, and the Arctic faded from public attention. Policymakers assumed ice meant irrelevance. Capital flowed elsewhere. Strategies were shelved. Greenland didn't lose importance. It simply waited. Like many assets in financial history, its value was underestimated because it couldn't be monetized immediately. Today, that assumption has collapsed. Russia has expanded Arctic military infrastructure. China labels itself a near-Arctic state. The United States is rediscovering positions it never truly abandoned. What looks like a sudden crisis is actually history resurfacing under new conditions. This pattern is familiar. Regions dismissed as peripheral often become central when technology, trade routes, or power balances shift. Oil once turned deserts into prizes. Shipping canals rewired empires. Now melting ice is reopening geography itself. Greenland matters now for the same reason it always did: location. It anchors the North Atlantic, controls access to emerging routes, and offers leverage no spreadsheet can ignore. Understanding this past explains why today's confrontation feels inevitable and why the real battle is about economics next. Markets are only beginning to price that reality in. This isn't about ice, it's about leverage. Greenland's true value sits beneath the surface and beyond the horizon. Rare earth minerals critical for batteries, defense systems, and advanced manufacturing are embedded in its geology at a time when supply chains are dangerously concentrated. Control over future Arctic shipping lanes could cut weeks off Asia-Europe trade, reshaping logistics costs, insurance pricing, and inflation dynamics. Energy security deepens the appeal. As traditional routes face choke points and geopolitical risk, Arctic corridors promise diversification. That matters to central banks, manufacturers, and governments trying to stabilize prices in a fragmented world economy. Publicly, leaders speak the language of security. Privately, the conversation is about who sets prices, who controls inputs, and who absorbs shocks. This is how power works in macroeconomics. Resources create optionality. Optionality creates bargaining power. Bargaining power becomes monetary influence. The country that secures minerals secures production. The country that controls routes controls timing. And timing in global trade is money. Recent policy briefings and market commentary reflect this shift. Investors are no longer dismissing Greenland as symbolic. They are modeling it as strategic infrastructure. That reframes the crisis entirely. What looks like diplomacy is actually preemptive positioning in a world of tighter supply, higher volatility, and strategic decoupling from rivals. Recent updates suggest policymakers are accelerating Arctic assessments, while firms quietly hedge exposure, anticipating regulation, tariffs, and rerouted trade flows sooner than public timelines admit, according to market chatter globally. And once leverage is visible, the question becomes how it is used. What if tariffs aren't meant to win trade, but to force obedience? Conventional economics treats tariffs as blunt instruments that raise prices, slow growth, and invite retaliation. Trump treats them differently. For him, tariffs are leverage, applied asymmetrically to create pressure where it hurts most. This logic assumes allies have more to lose than the United States in short-term disruption. Export-dependent economies, fragile coalitions, and politically sensitive industries become pressure points. The objective isn't efficiency, it's compliance. And that distinction matters to markets. Unpredictability is central to the strategy. By keeping timelines vague and targets shifting, uncertainty itself becomes the weapon. Businesses delay investment. Governments scramble. Markets struggle to price risk. Volatility rises not because tariffs are announced, but because rules feel temporary. Recent statements and briefings suggest escalation ladders are intentionally left open. Tariffs are floated, paused, reintroduced. This stop-start rhythm maximizes attention while minimizing commitment. It also alarms investors because allied retaliation risks turning controlled pressure into uncontrollable spillover. Historically, trade wars between rivals are damaging. Trade wars between allies are destabilizing. They fracture trust, weaken coordination, and invite third parties to fill the gaps. That's why this moment feels different. It's not just policy. It's a shift in how power is exercised. And Europe understands that now. Current market updates show hedging costs rising and policymakers signaling readiness, confirming that coercive trade tactics are reshaping expectations faster than agreements stabilize. For the first time in decades, Europe is preparing to fight back. Traditionally, European power has been exercised through patience, process, and quiet negotiation. This time, the tone is different. Faced with open economic pressure from an ally, European leaders are signaling that restraint has limits. Behind closed doors, retaliation plans are being drafted, not improvised. Legal instruments designed to counter economic coercion are no longer theoretical safeguards. They are actionable tools. Coordinated tariffs, regulatory pressure, and targeted responses are now openly discussed as legitimate defenses, not escalations. The message is subtle but firm. Leverage will be answered with leverage. What makes this moment unusual is unity. Fragmentation has long been Europe's weakness, yet recent statements, emergency consultations, and synchronized messaging suggest a shared red line is forming, not over ideology, but over precedent. If economic coercion becomes normalized inside alliances, the system breaks. This marks a turning point in transatlantic relations. Europe is not abandoning diplomacy, it is redefining it. Power is being reorganized quietly, institutionally, and deliberately. Recent updates indicate accelerated coordination between finance ministries and trade bodies, signaling readiness rather than reaction. Europe isn't posturing, it's adapting, and as politics hardens, markets begin to listen. Because when alliances recalibrate, capital moves next. Markets don't fear bad news, they fear unstable rules. In the short term, markets appear calm. Indexes fluctuate, currencies adjust, headlines fade. But beneath the surface, uncertainty compounds. Investors struggle not with tariffs themselves, but with the unpredictability of when, where, and how they might land. Currency volatility is often the first signal. Trade threats distort expectations around growth, inflation, and central bank responses. Capital shifts toward perceived safety, while long-term investment hesitates. Projects are delayed. Supply chains are quietly reevaluated. These decisions don't make headlines, but they shape outcomes. Wall Street's calm can be misleading. Systemic risk builds slowly. Tariffs raise input costs. Higher costs pressure prices. Inflation expectations creep upward. Consumers feel it later through wages, prices, and employment decisions. Recent market updates show hedging costs rising and risk premiums widening, subtle signs that uncertainty is being priced in. Businesses aren't panicking, they're pausing, and pauses, at scale, slow growth. This is how geopolitical tension translates into everyday economics, not through shock, but through friction. And that friction signals something larger is shifting beneath the global order. This isn't about Trump or Europe. It's about the rules of the next world order. What Greenland reveals is a deeper transformation already underway. Alliances are no longer built on shared values alone, but on transactions, leverage, and measurable advantage. Economics is replacing ideology as the primary language of power. For decades, the post-war system relied on institutions, predictability, and trust. Allies disagreed, but escalation was contained. Today, that assumption is eroding. Pressure politics is replacing consensus, and influence flows toward whoever controls choke points, resources, and market access. Greenland symbolizes this shift perfectly. It exposes how security, trade, and finance have merged into a single battlefield. Control territory, and you influence trade. Influence trade, and you influence currencies, growth, and political stability. Power is no longer exercised quietly through rules, it is applied openly through leverage. This moment forces uncomfortable questions. What does alliance mean when tariffs can be deployed internally? What happens when institutional guardrails fail to restrain unilateral action? Europe's response suggests the old model is insufficient. The world moving forward will not be divided cleanly between friends and rivals. It will be divided between those who possess leverage and those who don't. Greenland is not the cause of this shift. It is the signal. And signals like this rarely come twice. Understanding it now determines who adapts early, who resists change, and who pays later in global power. Greenland may decide how the next global crisis starts. From here, 3 paths emerge. The first is escalation. Tariffs trigger retaliation. Retaliation hardens positions, and a trade dispute between allies spills into investment, security cooperation, and currency markets. This path is slow-burning but damaging. The second path is compromise. Quiet negotiations diffuse public threats, face-saving language replaces confrontation, and markets breathe again. This is the optimistic scenario many expect. But history suggests it rarely restores trust fully once leverage has been exposed. The third path is more subtle and more dangerous. No dramatic trade war, no clear deal, just lasting damage to alliances. Rules become conditional. Cooperation becomes transactional. Each crisis sets a new precedent for pressure. This is why Greenland matters beyond this moment. It functions as a test case. If economic coercion works here, it will be repeated elsewhere. If it fails, new guardrails may form. Future conflicts will not begin with tanks or treaties. They will begin with tariffs, export controls, and market access. Greenland reminds us that the next global confrontation will arrive through balance sheets first and politics second. What happens next will shape expectations, strategies, and risk calculations far beyond the Arctic, for years to come across global markets, alliances, institutions, and emerging power structures.